Hey, hello everyone. Thank you for joining our financial webcast presented by Legend Financial Advisors entitled Market Turbulence, How to Handle Volatility. I want to thank you for joining our latest presentation. My name is Dan, the moderator for today's webcast. Today's webcast presenters are Jim Holtzman, CEO and President of Legend Financial Advisors, and Bill Knight, Wealth Advisor with Legend Financial Advisors. Please hold as I turn the broadcast over to Jim and Bill.
Okay, thank you, Dan, and thank you everybody for joining us today. We recognize this is a time of increased volatility and uncertainty about the economy and the stock market. It's also been a time where the news has had almost an immediate impact on the movement of the stock market, whether that's positive or negative. A major part of this uncertainty right now is clearly being driven by the tariffs and trade policies and the impact or potential impact on the markets and the economy. And just even today alone, watching the market fluctuation, it's been fluctuating between positive and negative territory throughout the morning. And a lot of that's just based on current updates on trade policy and where things may be heading. So we're going to cover some of the issues that are driving the market, what's working, what isn't working, and some of the importance of diversification. Also, too, we recognize that a lot of our clients attending today may wonder if we're going to be covering specifics about their investment portfolio, and we're not going to because we recognize everybody's specific situation is specific and individualized to them. But obviously, too, if you have any concerns or want to go over your portfolio, we're happy to do so. And I think one last thing, there's no quick fix to what is happening in the markets. So while we go through some of the themes and strategies and how we've been looking at the markets and the portfolios, just recognize there's not a quick fix. There's no real silver bullet to fixing everything that's happening right now in the markets. So with that, let's go to our first slide. And so this is a price to earnings ratio for the S&P 500. And when you hear the term price to earnings ratio, just think of it as being a valuation measure for the markets. Are they expensive or are they not expensive? And so just to kind of follow through, the blue line is not the stock market movement, it's the PE, it's the measurement, it's that price valuation for the markets. And it goes back quite a ways. So you can see we're going all the way back to even the Great Depression at these points. And the one thing that you'll notice is that for the valuations of the markets, very expensive. When you look at it just even over the course of the entire chart. And then you can see how the price to earnings ratio fluctuated over time. And I'll just point out a few main items. You can see going to 1982, for example, the PE ratio actually hit a very low point. And then we went on a major run with the stock market, which did fall in line with the price to earnings ratio increasing all the way till we got to the top in the year 2000. And then the markets went through a 3-year tailspin. You can see that reflected by some of the falling of the price to earnings ratio as the price of the market fell. And then we had another subsequent rise leading up to the financial crisis of 2008. And then you can see the fall off in the PE ratio that did occur over that time frame. And then from 2008 until basically going into the points of COVID in 2020, you can see that the price of the market overall did trend up and the price to earnings ratio trended up. There were certainly some dips along the way that you can see here. And then we had another drop off in the valuation ratio. And then we've had a subsequent rise over these last couple of years to where the valuations of the markets as of the end of February 2028 of this year, we're at a point where that number was 30.7. So we're not going to get into the calculation about how this is actually everything's being calculated. I think the main takeaway was heading into even the end of last month, you can see just kind of drawing a line across that the markets as defined by the S&P 500 on this chart were very expensive on a historical basis. And you can see the all-time peak was back in 2000, and we're not really that far off from that. And so the reason I want to bring this up is that we view some of this type of a chart to get some perspective about where the markets are. It's not a market timing chart. It doesn't mean because we're over a certain level, whether you pick here or pick here, that the stock market's going to have a more significant decline. But they are warning signs to us about the main stock market valuations being more expensive. And that leads to some of our thought processes in terms of diversification, which we'll talk more about as we go through this presentation, and just ensuring that we're diversifying across different parts of the market, because while the S&P 500 has been very expensive, there's other parts of the market that haven't been as expensive and present opportunities for your investment portfolio. So the next slide is the volatility index. You might hear this referenced as the VIX, and it's meant to really indicate what it sounds like it's indicating. Is it's a measure of volatility, and this pertains to the S&P 500. And I think your main takeaway, and this is on a year-to-date basis, so you can see how at the beginning of the year, it was choppy, but pretty much fluctuating within a pretty tight band until we got into this period where we got into March, and you can see volatility rose to about somewhere around the 26, 27 level, and then fell off again and went all the way back down to close to around 17 or so. But then you can see, and this covers the most recent volatility that we have seen, is a rise and then a really steep rise over the last couple of trading days to the point where the VIX is at 37.66. So it's helpful from our standpoint to understand the volatility, the measurements of volatility. The higher the volatility, generally speaking, the less positive that is for the stock market. When volatility falls off, generally speaking, that can be good for the stock market. So it just helps to get a feel for where we are in perspective to kind of historical volatility. We have information and it goes back further than the year-to-date that I'm sharing with you now. But clearly you can see just the increase on a year-to-date basis has been pretty substantial, especially these last few trading days.
All right. Hello, everyone, and thanks, Jim. So for this next segment, what we want to present and show you is a chart from Y-Charts. And this is the performance returns so far this year. And this is actually through April 3rd. So as of today, these numbers will be a little bit different and a little bit more dramatic. But what we wanted to show through this illustration is really that diversification works. And it's really been one of the areas of the portfolios today that has really helped provide some value in today's environment. And typically when we hear the news and when we're finding out more information about what is happening in the stock market, we're most commonly seeing the kind of the top three indexes, the S&P 500, the NASDAQ, and the Dow Jones. And mostly what they represent are large cap companies. And for most of the movement, especially this year and in the most recent business days, is there's been large movements in all of those indexes. So what we have here on this illustration really shows some different areas of the market, including ones that we've used in the portfolios and also some that we have not. And it's really just to provide some perspective and really show you that despite a lot of the volatility on the downside, there have been several asset classes that really have been performing well over this time frame. So if we look at the top of this chart, we can see that the top performer, and this is so far for this year, and this is through April 3rd, the top performer has been gold. And gold had a really strong performance last year. It's seen as a safe haven, and even though when there tend to be pullbacks, it can still lose some value. But gold tends to be a strong performer in environments like this, and that's really what we're seeing so far this year. So that's been the top performer. As of the 3rd, it was up over 18%. From there, we have an insurance ETF. So that's an exchange traded fund, and it's a collection of different insurance companies. And this is really just to show that one of the smaller sectors within finance has been performing very well. So insurance continues to perform well during this time frame, even though it is equities. These are mostly medium-sized companies, but within that specific segment, it has provided a nice rate of return. From there, we have the commodity index. So that was up just over 7%. And what's nice about commodities is they're not necessarily reliant on a strong economy to have good performance. So in any type of downturn, even in some longer downturns, commodities have really performed well. And so far this year, they've performed well. And what makes up this specific investment is a combination of a variety of commodities, whether it is something like gold bullion, physical gold. It could be oil, natural gas, soybeans, corn, and really a variety of underlying commodities. But that has performed so well so far this year. From there, we have a representation of how bonds have performed so well this year. And typically what is nice about this year and kind of different from what we experienced in 2022 is that there is now kind of a normal correlation between bonds and the stock market. So typically bonds are seen as more of a safe haven, especially in this type of environment. In 2022, that was actually different, where the correlation was very similar and bonds had one of the worst, if not the worst, market or return in market history. So what's been nice so far this year is that bonds, in particular, more traditional types of bonds, have performed well during this time frame. Now, going further down, we have a healthcare fund. So this is a proxy for healthcare as a general sector, and this is one area that tends to be a little bit more value oriented, and healthcare in general will perform better in a more volatile type of environment like we're experiencing today. So that's been another nice performer, relative to some of the more aggressive equities that we typically see. From there, we have the large cap proxy. And one of the nice things to think about large cap value is that typically value will outperform growth in a volatile environment. And the opposite is really true during a strong bull market like we've seen over the past several years, where growth really outperformed, especially technology companies, for example. But what we're seeing is kind of a slight shift towards the value side. And really with our portfolios, that's why we like to have a nice kind of equal weighting between those two, because you never know what's going to outperform the other. And so value certainly has been as volatile as the growth areas of the market, and we'll be seeing that next. From there, we have a representation for managed futures. Now that is a trend following fund, and managed futures, one of the benefits of managed futures is that you don't necessarily have to have a strong economy for that asset class to perform well. So for example, in 2022, managed futures during that down market where bonds were down about 13%, equities were down anywhere from 18 to over 30% for the broader indexes, managed futures in that environment was actually up about 16% on average. So as long as they have the ability to properly follow a trend, they do have the ability to be profitable. So that's an asset class that can provide a lot of value in this type of environment. From there, we have the proxy for the S&P 500, and that is really a broad collection of large cap companies. That's kind of a blend between value and growth. And that's what we see most commonly cited in the news today. And then from there, we have the NASDAQ, which is represented by the QQQ Trust. So the NASDAQ, that will primarily be technology based, but there will also be cyclical companies that are more in the retail industry as well. So it's just not pure technology, but you can see just given larger exposure to technology and large cap growth companies that it has been more volatile when compared to something like the S&P 500, down almost 12% on this graphic. Next from there is a representation of small cap companies. Now that's down just over almost 14% as of the 3rd, and that is a broad representation of small cap companies. And then from there, we have a exchange traded fund that is a pure representation of technology. So that will be 100% technology. And we put that on there really just to show where the most volatile part of the market is today. Now, technology has really performed well over the past 2 years. It's really not just the past 2 years, but really over the past decade. It's really been the strong growth component of the market, and it's become an increasingly large part of some of the different indexes like the S&P 500, for example. And it really just goes to show that, given the upside over the past several years, it's kind of been expected that if we were to have some type of volatility or downturn where some catalyst like tariffs would cause volatility, that would be the one area being most overvalued that would be most susceptible to a downturn. So overall with this, the key takeaway is really that it's important to have diversification in the portfolios, and that's really how we have constructed the portfolios. And we'll actually talk about that a little bit more on the next slide. So with this next slide, this is a correlation matrix, as some of you will recognize. And this shows the same investments that were on the previous slide. Now, not all of which that we own, but is really just to show you how those types of investments correlate to one another. And it's another point to hit home in terms of the effectiveness of diversification and why that makes sense in particular in a year like this year. So when we look at this chart, it shows the correlation of the investments over the past 3 years. And this is a graphic from Morningstar. And what this shows is on the bottom portion of the page, we see the degree of correlation. So on the left side, we have the dark blue, which shows a high degree of correlation. Now, there's only a few investments here that have a high degree of correlation, and not ones that we actually have correlated in our portfolios, for example. But one of those just shows that technology, number 2 and number 11, have a correlation of 0.98, and that's really because they're both technology funds. So that's why they're moving in the same direction. Now, what we're looking for when we go to construct portfolios is we're trying to make sure that we have investments that will not always move in the same direction, really for environments like this. So whether that is something like a trend following fund like we have in number 1, you can see that the correlation among other investments is in that moderately negative range. That can add a lot of value, whether it's a year like 2022, and we're looking for that to add value this year, being a different type of asset class that is not necessarily dependent upon a strong economy to be able to perform well. Other areas like that really tend to be items like gold, which is number 5, and items like commodities that really have the ability to provide a different type of return profile and be less dependent upon what is happening with the with the current strength of an equity market. So that becomes an important focus for us. This is how we construct portfolios, taking these items into consideration. And when we think about the overall strategy to manage risk, this is really one of the key areas that we use in portfolio construction, and really provides a lot of that downside protection that we have in the portfolios.
Okay, so we're going to talk next about portfolio rebalancing. And this is a really important concept to use so that when the markets get to be very volatile, it helps you avoid doing a lot of knee-jerk reactions. Because if you're rebalancing the portfolio along the way, then you get into situations where your investments are not becoming too large a piece of the portfolio. As Bill mentioned earlier, technology has had quite a run over the last even arguably 10, 15 years. And if you didn't rebalance that area, what may have started as, let's just say, a 20% allocation in your portfolio could grow even to as high as 50%, even higher of the investment portfolio. And so you want to be careful about that, because now you have a significant amount of risk in one part of the market. And so what we use rebalancing for is to have a very disciplined approach where we're taking profits off the table, and we have specific parameters that we use to determine that. So an area like technology, an area like gold that is done really well, when the position size of technology gets to be too high, in our view, we have been disciplined in taking profits off the table. And so we do that for a couple of reasons. One is to reduce that exposure, because as that particular area of the market, like technology, continues to do well, it is also increasing the risk in the portfolio. So we want to be careful about how much of that risk we take on. And then by taking the profits off the table, it also opens up opportunities to deploy that cash into parts of the market that maybe are less expensive. And so you get further opportunities from that. So we've done that over the last several years on a very consistent basis when those kind of internal triggers are hit, so that we are able to do that rebalancing and keep the risk within a reasonable profile, which is what our clients are expecting us to do. Some of the other areas that we follow to help us on the rebalancing process, there's a style of investing called growth investing, another style called value investing. So we monitor those areas very closely in the portfolio. We keep track of what the percentages are in each of those areas. And again, if, for example, growth style investing in the portfolio increases too much, well, that's also another trigger to us to look at the portfolio, maybe pare back, take some gains from the growth style in the portfolio, and perhaps reallocate that to value investing if that hasn't done as well. Another area that we look at for rebalancing are the types of companies that we're investing in, or type of funds that we're investing in. If they're primarily focused on small companies, mid-sized companies, and large companies. So again, we have some very specific parameters we follow there, target percentages that we're following. And if a part of the market, say large cap, which has done so well, starts to become too high within the portfolio, we're going to do some rebalancing to, again, take profits off the table, reduce the risk in the portfolio without necessarily harming the future returns of the portfolio, because we're now reallocating those funds to a less expensive part of the market. And then just one other part on the kind of the equity part of the portfolios that we follow very closely are the sectors that we have our clients invested in. So when I talk about a sector, I mean sectors like technology, healthcare, financial services, industrial type companies, just to name a few. So on the equity style, we follow that very closely for the same reasons that I've been outlining before. If, say, technology, again, has that very big run-up like it has had, then we're able to see and have kind of our triggers in the portfolio to tell us we need to take a look at this and make a determination. Are we going to take profits off the table at that point? And if so, how are we going to redeploy that cash? In the bond section of our client portfolios, it's the same concept as well. Different kind of triggers with bonds versus equities, but we monitor the amount of interest rate risk we are taking in the portfolio. Interest rate risk is the risk of interest rates going up, bond prices falling down. There's also credit risk with bonds in terms of the quality of the bond positions. So we again have disciplined approaches to each of those areas that we follow. And whenever we believe there's a shift necessary, we reallocate. And again, it can be profit taking, reallocating into another part of the market, the bond market this time, that is maybe better priced. And so we're doing these kind of reviews consistently on a daily basis and have been using that over the last couple of years to help rebalance the portfolio because we don't know when these kind of downturns are going to occur. So we want to, at least to the best of our ability, try to be ahead of this as much as possible and take those profits when we can and when we think it's the right opportunity. So we've been positioning the portfolio over these last several years as the market run-up has continued and reducing the risk in the portfolio so that in a year like this year, at least so far what we've seen, as Bill outlined on the prior slides, you have parts of the market like gold that have done very well among some other areas, including the traditional bond market.
Now with this next illustration, what we want to be able to show is how we identify opportunities in this market. Obviously with the volatility, it can create concern, but it also can create opportunity. And one of the illustrations that we view and keep in mind is this illustration from GMO, and it's titled the 7-Year Asset Class Real Return Forecast. So this is a forecast for returns after inflation is accounted for. And you can see from the left to the right, we will start with the US large cap stocks. So you can see that that is anticipated to have a negative return over the next 7 years. And as you work your way to the right, you can see some of the areas of opportunity that start getting into the blue areas when it comes to stocks. So that would be some more opportunity set in international and even emerging market stocks. On the right, you have performance returns for different types of bond funds being a little bit lower. And ultimately, what this does for us is it's not necessarily a vehicle that we use for timing purposes. Whereas, this chart itself hasn't changed largely over the past several years. And what we've experienced over the past several years is US large cap stocks have performed very well. And whereas international and emerging market stocks have lagged quite significantly. What we use this for is we're trying to identify any potential pitfalls, with one of them being US large cap stocks, and making sure that the way that we're constructing portfolios, it is not too heavily weighted to an area that might be of concern in terms of future expected returns. And we also keep in mind where we should be trying to identify opportunities, whether that is in international markets or in the emerging markets. So we have several funds on our radar that we keep in mind when it comes to continuing to diversify the portfolios. And this is just one of the examples that we review every so often just to get feedback in terms of where valuations are today and how that might affect future performance when it comes to the portfolio. So this is something that when we are constructing the portfolios, it helps provide feedback in terms of what type of percentage for equities, for example, we might want to have in large cap stocks as a whole, and what percentages we might want to have in domestic US stocks relative to international stocks.
So hopefully that gives us a better understanding about what we're doing in our portfolios. And, most importantly, going forward is, using charts like this to help guide us on the allocation percentages as Bill outlined. The portfolio rebalancing, kind of allowing us to control risk along the way, because we don't know when these downturns are going to occur, nor do we know when these downturns are going to end. So that's why it's so important to constantly review the portfolios, make informed judgments about what we're seeing and what we're also anticipating in the markets, while having a good high-level understanding about the valuations of the markets. And so a lot of those tools are used in concert with each other to help guide us in our future decision making. So with that, we wanted to make sure we allow plenty of time for question and answers, which we'll be happy to do, and you'll be able to enter those in for us to view them. So we'll just give a minute to see what questions we have so far. So one of the questions has to do with the movement of the markets and changes to the economy we're seeing. Will the Federal Reserve be reducing interest rates as a result of that? And that is a question that's still up in the air. There's been, over the last week especially, a little more of a potential for them to lower interest rates as far as expectations go. However, they also have a balancing act. They're also keeping an eye on inflation. And if they lower interest rates, all things equal, that would encourage more spending, more potential inflation. And so while the Federal Reserve lowering interest rates, generally speaking, is viewed as a positive for the equity markets, that's not really their mandate. Their mandate is following inflation and the job market. And so as long as inflation still continues to kind of run at a higher level, with the potential for it being higher, the expectation, at least we have, is that they're not going to be lowering interest rates too much this year, although the data can certainly change really quickly. And so the other part of the interest rate world is longer-term interest rates like mortgages. That's been an area where we've seen long-term rates come down over the last, especially the last month, even more so over the last couple of weeks, with this increase in volatility that we have seen. That's also been part of the reason why the bond allocation in our client portfolios has been very good, because as long-term rates come down, bond prices go up. So some of that cushioning effect that Bill mentioned earlier, that has normally occurred when the stock market has a drop-off, we're starting to see that occur again, and that's been a very beneficial thing, at least in terms of reducing some of the volatility. Okay, another question. How do you account for older investors' inability to have a long-term view and be able to wait out the current market chaos? And so it's a couple-fold answer to this. First is in terms of going through the risk profile for all of our clients and getting an understanding about how much risk you're able to take on, how much volatility you're able to take on. And it's one part of the answer to this. The second part, though, is also in terms of what your longer-term investment goals are. And sometimes that can pertain to just yourself. It also could pertain to your heirs, who would inherit your money. And so it's kind of a couple of fold, very personalized answer at the end of the day with it, because sometimes that view, if you will, is still long-term, because you're thinking about it maybe over the next generation as well. But that's why we'll always want to have the feedback from our clients in terms of risk while we go through the questionnaires. And it's really meant to trigger those conversations so that we can have a good handle on what our client goals and expectations are.
One of the next questions we have is, would it be a good time to change the portfolio ratio? And when it comes to the amount of debt versus equity in the portfolio, similar to what Jim just mentioned, it's always a good time to review and take a risk assessment to provide feedback in terms of whether or not you're in the proper portfolio. One of the difficulties is trying to make too many changes in an environment where we could have some type of rebound, and it being more difficult to time those types of changes. But certainly it's always a good time just to be able to check whether or not the level of risk in your portfolio is appropriate for you and in relation to what your cash needs could be or in relation to your goals. So that's certainly something that we could do in terms of scheduling a meeting and sending you the risk assessment link or going through that together.
Okay, our next question is, can you comment on the brief spike in the markets today? Did this indicate an underlying strength or not? And that's a really good question. Because today has been extremely choppy in the markets. And from what I've understood so far this morning, there was at least a story out there that President Trump was going to put a 90-day kind of reprieve on the tariffs that were announced last week. And so that comment, and it's being debated whether he actually made that statement or not, but it came out in the news. There was a number of articles about that, and that caused the markets to spike higher today for a period of time. But then the White House apparently came out and kind of debunked that news, and the markets fell back off. And so it's hard to say that would be a strength or not, because it really seems to be based on a story that wasn't necessarily true. And that's what I meant by at the beginning, is that the markets are moving very quickly today based on the news of the moment. And that's normally not the case unless there's really significant events going on. The normal day-to-day news environment, if you will, normally doesn't have this much of an impact on the markets. These are clearly different times, and you can really see that spike occurring at the time those news stories were coming out about a possible 90-day reprieve on the tariffs. And then as soon as that story was debunked, then you see the markets falling off just really almost in real time. So until we hear a little bit more about that, whether it was true or not, or whatever the story is behind that, really hard to answer that in the moment, especially given just kind of the continuous changes to what's happening with tariffs, whether it's what countries are going to pay them in the first place, what the rate's going to be. It's been increasing and decreasing within the scope, within the course of the day. And so it's really tough to, get an idea of where things are really going to be heading. And I think we're going to see more of that, over the short term as these issues are maybe worked out a little bit more. There was this also news about other countries, like 50 different countries wanting to negotiate already on the tariffs that were announced. That's going to cause volatility, whether positive or negative will depend on the specifics. Okay, another question is, if there is a manufacturing upturn as predicted, will the U.S. have a trained workforce to meet the demand? And it's a really good question. It's one that there's no perfect answer to, because we don't know which, if any, type of manufacturing jobs would be increasing in the U.S., but certainly having a trained workforce to meet that demand is every bit as important, because if we don't have the trained workforce to actually fulfill those jobs, that's not going to be very beneficial to those companies. So as you hear about semiconductor companies moving some of their production to the U.S., there's the other side of that, though, is that we have to have a trained workforce to meet that demand. So it's a really good question. It just depends on the specific industry. There would have to be, to some degree, retraining happening to meet those demands if those jobs were to increase in the U.S.
One of the next questions is, what should be done with cash in a money market account? And that will really be dependent upon what your goals are with the cash in a money market account. For most of our clients, that tends to be money that is set aside to act as a cash reserve, whether it's an emergency fund or for a larger goal or an overall dollar amount that you'd want to set aside and keep safe. Now, that's something that we would continue to have confidence in terms of it being more of a safe haven type of investment, where the nice benefit of it is, unlike a traditional bond fund, for example, the underlying value of the money market fund will not fluctuate. It will remain the same. And what we would anticipate over time, right now with the interest rate that we're receiving in the money market fund, being just over 4%, is when interest rates decrease over time, given those are the current expectations, not necessarily knowing when that will happen yet, is the yield on the money market fund will decrease when that happens. So that's certainly a safe area to keep reserve money for the time being. And that would certainly be an area that will continue to be of value in an environment like this.
Okay, and our next question is, using past history of tariffs, what is to be done? Nothing versus some specifically. It's a really good question, and it's difficult to use the past history of tariffs in this situation because oftentimes, historically, depending on which years you're looking at, sometimes tariffs are used very specifically to protect a specific industry. Steel could be an example of that, and there could be national security concerns, and it doesn't always mean that that particular area is not going to do well. Whereas right now we're seeing kind of more across the board tariffs at least being proposed at higher levels than we have historically. And so it's challenging to use the past history of tariffs for the future decisions that have to be made. Generally speaking, when you look at the overall history of tariffs, especially back in the 1930s when they were increased significantly, it was not good for the markets. It was not good for the economy. It was obviously a different time back then, but that was an example of where tariffs were they were detrimental at that time. So the tough part is today, as we're dealing with, if you just even look back over the last few months on the direction of tariffs, if you just took kind of the daily headlines out of the news, you could just see the constant fluctuation, tariff on, tariff off, tariff rates going down, going up, changing quite often. So it's tough to make those decisions on a day-to-day basis when you don't really know where the end game is, which does go back to diversification in the portfolio being important, because you don't want to be betting in one particular area of the markets or the economy versus another. So right now we're not changing the investment strategy from a standpoint of trying to bet which industries are going to have tariffs or which countries are going to have them and at what level. Because there's also, too, what doesn't make the news so much on a daily basis is a tariff gets announced, and then you think, okay, this industry is going to really be hurting. But then when you hear more of the details, they're doing what's called carve-outs, and those carve-outs sort of make some exceptions within that industry that aren't going to be hit as hard by those tariffs. And so that's a moving target right now. So we just want to be careful from our end that we're not going to be whipsawed, kind of following back and forth where the different tariffs are getting announced, because the carve-outs are sometimes just as important as the tariff itself. The next question, since the usual strategy seems to be using historical trends, does this still make sense in these totally unusual times that might change things forever? And that's a really good question, because the historical trends, they can only get you so far. it's important to understand the historical trends and kind of the impact that has happened on the markets, whether you're talking about tariffs or really any other economic type of indicator. That's why we use a balancing act, like even the chart that we still have on the screen, that 7-year asset class, that's a forecast. That's looking forward, taking all of the current information and projecting forward what's going to happen. And so obviously there's a lot of moving pieces right now. These tariff issues really need to settle down for the markets to digest what's happening, for the companies or the industries to digest what they're going to do going forward. And so certainly historical trends aren't going to do too much in that regard. And so that's why there needs to be a balancing act, looking forward with the data that's coming out and making more informed decisions and making sure the diversification is still there, because those the correlation chart that we showed earlier, those are really important to follow. And to give you an idea too, with like the correlation, so if we were looking at that same kind of a chart, just say 20 years ago, parts of the market like real estate had very low correlation to the U.S. stock market. And now today, those correlations have increased. So you don't get as much diversification out of real estate and investment portfolio. So it's a good example of being careful about using the historical trends, because things have changed, and things have changed quite dramatically on those fronts. And with all of the changes that we're dealing with right now related to tariffs, related to market volatility as well, we have to be nimble and flexible, in these environments.
So one of the next questions is, are you implicating broad tariffs may cause a recession or worse? And I think when it comes to the tariffs, obviously that has been a subject that has caused volatility. When you're looking at the overall economic environment and looking at different factors, whether it's overall production, how employment has been moving, and how growth in income has been moving, there's been several factors that we've been experiencing really with the year-over-year trends, whether it's in employment. For example, with employment, it's been a little bit more at a stall speed, where there's been growth, but it's been minor. When it comes to income growth, that has always also been more minor as compared to the last 2 years. So those are some factors that have already pointed towards kind of a slower growth economy. So this is, I think tariffs is more of a subject that is certainly causing a lot of uncertainty, like Jim mentioned, and is really causing volatility during this time frame. It's hard to say whether or not it could cause a recession or something worse, because at the end of the day, if there were some type of changes, whether it's later this afternoon, tomorrow, or this week, that could have a big change in the direction of what we're going to see. So I think it's more of a matter of trying to see how the development of items like production, employment, and income move over time, and how what the ultimate changes of tariffs will affect that.
Okay, and our next question. So the federal tariff policy has thus far dominated the broader market behavior downward. For the duration the tariffs remain in place, are there any sectors or specific areas powerful enough to overcome the downward pressure from the tariffs? So I think the first part of that, at least right now, is we have to get some more clear direction about what tariffs are going to be in place, and various specific ones that will be in place. Generally speaking, the idea is to get more production in the United States versus other countries. So for companies that have more of a domestic focus in terms of production, those would be areas that, at least in theory, could benefit. Now, it does depend on specifically what areas. The steel industry is a really good example of that. If there are, more tariffs issued for foreign steel coming into the U.S., then U.S.-based steel producers, in theory, would have some better growth opportunities as a result of that. So once this all settles down a little bit more, then yes, there can be some areas of the market that can overcome that pressure from the tariffs. Farming is another area, with it, if we're going to have farming placed on, from countries that are importing food to the U.S., then, farming could be another area, or industries that are helpful towards farming here in the U.S. So there's a couple of examples, and you really can go all down the line to semiconductors, technology companies. There can be opportunities that will come out of this, but there just needs to be a little more clarity in where we're going to be going forward. Okay, so it looks like those are the rest of the questions, but as I indicated before, we are happy to have a one-on-one call with you to talk about your situation more, to address more specific questions. You can also feel free just to reach out to us by email if you want, responding to the survey that'll come up after this webcast, but we are more than happy to go through specific questions on your situation. So with that, we're going to turn it back over to Dan.
Great. Thanks, Jim and Bill. A lot of good information you covered today. I want to thank everybody for joining us for the webcast. If you'd like to schedule a conference call with a member of our advisory team, please call our office at 412-635-9210, or use one of the links that I put in the chat to schedule an appointment. Thank you again for attending the webcast, and this concludes the event.